Hi there, this is Charles Goddard. I just wanted to demonstrate something to you that I thought it would be easier if we looked at a chart together. We're sitting here in the first few days of March. Markets are collapsing and everybody is wringing their hands over um, that occurrence. And I just wanted to show you that what we're looking at here is S&P 500 since the year 2000. And the reason we're doing that is because my contention is that it's not that surprising, and that the people that knew it was coming. So let's just go through um, a very basic warnings that you can use when you're looking at stocks or ETFs or whatever currencies, commodities. It doesn't matter. And what we've got on the price panel is you've got three arrows that are pointing up, and on the momentum panel you've got three arrows that are pointing down. So this chart is very long term. It's a monthly chart. That means each candle is 1 month of price action. But what we could see back in 2000 is that while the price was moving up nicely, the energy was moving down. Now this is a classic warning that all is not well in the marketplace. And so this is actually when I broke with the my normal way of working, which was as a financial planner and then having money managers look after pools of capital on behalf of my clients. And none of them moved any of my clients into cash. Consequently, they took a beating during the downturn that came, and they had no explanation for me other than they thought it should be my job to move them. Well, I didn't really know the market from that point of view, that I would know when to get in and out of things, but I decided I would make it my business and started to work from that side of things. The second arrow you see is I was at that point managing actively, and I was a discretionary portfolio manager. And when I noticed this divergence had appeared again on the long-term chart, I put a trend line on my chart, and as soon as it crossed, I took all my clients out of the market and put them in cash. Consequently, they did not suffer one penny of loss in the ensuing collapse. Now, the third arrow up on the right hand side here, you could see the market has been going up quite nicely for quite a long time, for quite a distance. And you can also see that the energy has been going down for quite some time. And so this market has basically been in warning mode for a long time. And and so what we've got is the same, to me, the same deal. When new highs in the market are not matched by new highs in momentum, you need to take that as a warning. Now, it doesn't mean necessarily you have to do something, because momentum could go back and correct itself, and all is right with the world again. But as soon as the trend line is crossed, you should be out. So if you were to look at a daily chart of the S&P, you would see that that occurred, and you needed, so as soon as the divergence appeared, you would tighten your protective stops, and then once the trend line was crossed, you would be out altogether. So that's on the S&P. It's just that the warning has been there, and this wringing of hands I find a bit disingenuous. Anyway, we're going to take a quick look at Apple, and that's on the daily chart, so you'll see what I mean. All right, so what we're looking at here is a very recent chart of Apple. We're in around the 8th or 9th of March on this chart. And what you can see is the same thing that I was demonstrating. This is actually a daily chart. You can see the upward arrow in the price panel, and there comes a point at the vertical line where the price is continuing to move on up, but the momentum is heading on down. So again, my what I do at this point, like I said, it's very basic and simple. I see a divergence, and you don't see a divergence every time. But when I do, I take it as a warning. I take it as a warning only because it can correct itself, as I've mentioned. So I put a trend line on with that, so that when I see the price cross that trend line, I am out of this position, and I don't know how it gets any easier than that. So there are a lot of traders out there, and all they do is trade divergences. So I've just shown you examples here that you will learn in the books, and how you can make use of this information right away by looking at charts of your own portfolio. Anyway, thanks very much. I just thought it'd be easier to talk this through while we share a chart than to try and write it out. It's quite a bit of detail. Okay, thanks again.